Gives me great pleasure to bring on board Mr. V Vaidyanathan of IDFC FIRST Bank to talk about this consistency in the number which now first surprised everybody and now has delighted everybody. The bank has turned, things have changed, but is the change here to stay? Is this all about individual changes as an organization IDFC FIRST Bank has done, or this is also about the massive tailwind the sector seems to be enjoying? Mr. Vaidyanathan, another very strong quarterly performance, all-round growth, you cannot find fault lines. I'm going to start with a report from Morgan Stanley, which in their headline has said that good quarter, all-round growth, and we remain optimistic about the franchise value. This is coming from a firm which maybe 3-4 quarters ago, in a sense, that dismissed the great turnaround in IDFC Bank.
Well, you know what? They had a negative view on our bank for 3 or 4 years running. So for us, it's a massive endorsement, and coming from a brand like Morgan Stanley, who's known for good quality research and respected by global institutions, we think we're very happy about that. Yeah.
Okay, specifics now. What has worked for you for the quarter gone by? What were the factors at play?
See, actually, you should not look at what happened last quarter, because a quarter is a very short time. What we are seeing is a work done over maybe 3 or 4 years. People could not see it at that point of time because there were so many clouds, because of the legacy assets and this and infrastructure bonds that were high cost. So our real work of what we were building was clouded by these kind of issues. So today, those clouds gradually going away, the true model is beginning to show. So that's the way to think about it, actually.
Okay. So let's talk about the two factors. One, the deposit growth, stroke Casa, at a time when there has been literally a fight or a war of liabilities. You've managed to grow your overall deposit at 36%, sequential growth of 7%. It's been a tough time for the banking industry to get low-cost deposits, but you are growing at an enviable pace. Why, how, and will it sustain?
Actually, this is a very important question. Still, when people think of our bank, sometimes they think, look, can you really do this again quarter after quarter, particularly because deposits? Now, what is really, our Casa deposits, mind you, because money is moving to term deposit, Casa deposit is up 27% YOY. I think one of the key reasons is that we have now become a brand, and a good brand. It's not like more well-known. It's a brand with a certain character people associate with us. And a brand makes a huge difference to an institution, because it just swings. There are other banks which pay similar rates than ours. But I think it's very material for us, the way the growth is coming.
Okay. You are guiding for a steady margin trend, as the higher cost of funding will be offset by the repricing of MCLR and fixed rate book. Could you elaborate more on that? Because at a time when interest rates in India are peaking out, historically we've seen that margins, they tend to peter down rather than stay robust.
That's a good question, actually. See, in our case, it's no doubt that the cost of deposits is catching up, because deposits cost catch with a lag, because fixed deposit rates, the way it works, or the stock repricing. But for us, there is also a countervailing factor where we're repaying. Remember, we're repaying about 20,000 crores or 17,000 crores of 9% money, and we're replacing them with probably 6% money. So we are getting a benefit there. So that kind of offsets. We do still believe that our margins will be, like currently it's down about, I think, 9 basis points over last quarter. It should be somewhere here. Even if it comes down by a few basis points, maybe 4-5 basis points, really we don't bother about these things, because we have a pretty good margin already. And actually, it should not make any material difference to our earning, profits. Don't bother about that.
Okay. So one has to, let's say, talk about the big picture, and without getting into specifics of numbers here, but just something on the trend. This kind of a growth what you've reported for FY23 and the first quarter of FY24, do you think this kind of a trend, both in terms of growth as well as trajectory, will it sustain for at least next 3 more years?
I'm very, very confident of that. Let me put it like very straight. We feel that our operating profit will continue to outpace our loan book growth. Our loan book, as you know, we guide for 22-24% in that zone. But let me just say our profit will outpace it because we are getting the operating leverage kicking in. Let me tell you one number, for example, Nikunj, just for this quarter that's just ended, YOY. Our loan book grew by 24%, but our NII grew by 36%. Our operating profit grew by 45%. Our PAT grew by 61%. How's the magic happening that you grow the loan book by X, but operating profit grows higher? I think it's fundamentally very strong about the business model.
Okay. Historically, there has been a drag because of your wholesale book. And I just want to bring this point out for our viewers. That, in a sense, was also dragging the aggregate picture down. But now you are at the tipping point, like you just mentioned, in terms of the other businesses which are firing full cylinders. Do you see the entire migration of the drag of the wholesale book and that adjustment? Is that behind IDFC?
Yes, we don't think any material loss is going to come from the legacy book. That story is over. But there is one upside waiting for us here, at least we feel, and you will see it. In the infrastructure book, we still have about 4,000 crores of loan book, like 3,600 crores. There, our NPA is 23%. Our net NPA is 15% there on that book. So we are pretty confident that that book will go away in 2 years. So when that book of 25% or 23% NPA goes away, the rest of the book, which is retail, SME, and corporate, they are like really good. At least I'm looking forward to those infra. It will be a tail infra going away.
You've done many first, if I may use the term, in terms of renovating the entire rules of the banking industry. A new scheme for credit card, very high on customer experience, a very strong interest rates on savings for savings and for fixed deposits. What is the next big innovation we should expect from IDFC FIRST Bank now?
High rate was not an innovation, actually. We were paying a higher rate because our bonds were at 9. Even 7 looked great for us. That's why we're paying. But now we're paying only 4% of the 10 lakhs in savings. It's not like a massive difference. But the big thing is that really we are like going crazy about customer service and customer experience. Normally nothing upsets me in life, but this thing about here, customers are upset about something. It really, it bothers me. So we are like trying to build a bank systemically, which is very, very high on customer experience. We train our employees, we motivate them, we tell them that customer is everything. So we are trying to really build a customer first bank. You'll be surprised. This is not just, English mumbo jumbo. Actually, there's a lot of power in it. When people experience the brand, they refer us ahead. Even at reasonable rates, you'll get a massive, alpha on deposits if customer service is good. That's what we're trying for.
As you grow and as you continue to grow at a rate which is much higher than the industry average and much higher than what your peer sets are reporting, how would you take care that the balance sheet does not get over leveraged and risk is not compromised?
This is really a very important question. I'm actually happy you asked it. For us, frankly, we are guiding only for 22-25% growth. First of all, we're currently growing at 25, but think of it like now in this country, when even large banks like ICICI Bank, HDFC Bank, after being 25 years in business, are still growing at 20, for a low base, 25 is not a big deal. So that's one thing. But the more substantive reason is that this is a very key reason, we track and we lend to cash flows. So this is very important. And we are not lending to security. People say, oh my God, I got a home or a car. All that is of course important, but we are lending to cash flows. We see money in the bank or assess money in the bank.
Exactly a year ago, everybody was over obsessed understanding that what implications the fintech revolution will have on the banking sector per se. The fintechs were innovating, the balance sheets were cash funded, they were growing by burning equity capital. But given where interest rates are, how valuations have reversed for the fintech space, do you think this entire fintech fear which was there, is that fear now behind us, both in terms of innovation and eating into market share of traditional Indian banks?
I actually, if you don't mind, actually, I was in the contra side of it. I actually felt that all that is opening the market. When you think of fintech, think of all the technology firms who are adding value to a loan process or a deposit process. Uh, that is itself very big value. Second, as for reaching out the market is concerned, I even then believed, even today believe that every one of them opens segments of market which traditional lenders may not do, and that eventually comes to the lending system. So you could think of Geo like that, or you can think of any other technology firm.
Mr. Vaidyanathan, if I map the journey of IDFC First Bank, in COVID it was about survival, then it was about burning the midnight oil and turning the franchise around, which you've done, and then in middle of that came the IDFC and IDFC First Bank merger as the trigger. So it has worked beautifully for minority shareholders. Every 6-8 months they've got something really exciting which in a sense has re-rated the stock. So for next 12 to 18 months, what really could be the trigger?
Funny you're saying that, because the first or two or three triggers were actually bad news for investors. First we announced, loan of, Diwan housing going down, then we announced Reliance Capital